Welcome everyone to today's program, which is brought to you by Ambulatory Alliances. I am Robert Kurtz, moderator for the webinar. The program will begin with a roundtable discussion between our panelists, and then we will have a question and answer session following completion of the roundtable. You can submit any questions you have throughout the webinar by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Our panelists will attempt to answer as many of your questions as they can during the Q&A portion of the program. It is now my pleasure to introduce today's panelists. We have Blayne Rush, President of Ambulatory Alliances. Blayne is an SEC-registered and FINRA licensed investment banker. He specializes in ASC brokerage, ASC turnarounds and increasing ASC valuations through physician recruitment and syndications, and access to capital markets and capital structuring consulting for surgery, urgent care, and radiation oncology centers. We also have Curtis Bernstein, who is Managing Director for Sinaiko Healthcare Consulting. Curtis specializes in providing valuation, transaction advisory, strategic, and operational consulting services to clients. He has extensive experience working closely with hospital systems, physician groups, ambulatory surgery centers, and other healthcare providers. We will now begin the roundtable discussion. I'm going to ask Blayne to take our first question. Blayne, can you discuss what is the difference between syndication and physician recruitment?
Yeah, thanks, Rob. I appreciate you organizing this webinar. Physician recruitment is the process by which we recruit physicians that will do procedures in our surgery center. When we refer to physician recruitment, we're not recruiting that physician to invest in the surgery center, at least not until we've established a substantial relationship with them. We want them to use the surgery center for their cases. And syndication simply refers to a private securities offering of ownership interest in a healthcare company. We run across this term most often in the selling ownership interest in the surgery center business, but you can syndicate just about any kind of healthcare company, be it surgery center, medical office building, medical equipment company, and so on. But syndication typically takes the form of a sale of limited liability company units, limited partnership interests, although they can also involve the sale of shares in a corporation. Physician recruitment in terms of surgery center is always part of the syndication process, but syndication is not always part of the physician recruitment. This point will become very, very important to understand as we move through this webinar. The differences are important in the process, as you'll become aware of.
Curtis, would you like to add to that?
Yeah, from a valuation perspective, the interesting thing is we deal with a fair market value standard. So to Blayne's point to some extent is if you recruit the physician in to use the center, and let's say you have an orthopedic surgeon and they start doing 200 cases per year or however amount that they can do within that specific surgery center, and then later they decide they want to buy an interest in the center, well, we can't just totally ignore the historical volume that they've been doing in the center. I know that becomes an issue in a lot of the cases we get involved in, is that the physicians don't want to buy an interest in their cases that they're already doing. Well, from the fair market value standard, we need to look at what's the actual history of the center and the cash flow that's being brought in. And when we talk about trailing multiple of EBITDA less debt, we'll be looking at the EBITDA, which might include some of those cases. So it's something to consider when you're recruiting a physician, or if you decide if you want to actually sell an interest to that physician through a syndication, is how much is that physician bringing in? Obviously, the good part about recruitment is you get to see how much the physician can bring in. So if the physician's only a very limited user because a lot of their cases are inpatient, well, then you may not want to syndicate to them. But if they are a significant user, you'd probably want to syndicate to them first before they start using it, because that does become an issue in the valuation later.
Thank you, Curtis. I'm going to turn the floor back over to you, Blayne, to begin the discussion on our next question. What does an ASC need to do to prepare to recruit new physicians and or syndicate?
The preparation all depends upon what stage of the life cycle that the surgery center is in, but a good bit of the process that we'll discuss is the same. So let's, for the discussion, start from the pure recruiting physicians angle around an existing and operational center cycle. So it's already in play. There's people doing surgeries there now. And in the physician recruitment area, one of the first things that you want to do is evaluate the center to see if and why any of the current physicians are not bringing all of their qualified cases to the center, and then figure out what the barriers are. So essentially what we would suggest is that you meet with each physician and ask a question somewhere along these lines. What can we do differently that will make you more comfortable in bringing all of your appropriate cases to the center? And the reason that this is important is because you want to understand the shortfalls and where they're occurring, because it's very important going forward, because any operational inefficiencies will strongly affect the recruitment and retention of cases in the new docs. So you want to go backwards so you can go forwards. And it's important that the leadership understand that their top priority is to remove as many barriers as possible in order to make it as easy as possible for the surgeons and physicians to perform all of their qualified cases. So you want to create a culture of yes, which sounds simple, but this is a top issue that I see when we go in and help centers recruit. You want to create pro formas that can qualify the financial benefits of adding only a few more cases per month, because you want the existing surgeons to understand that incremental case volume growth leads directly to higher margins, because obviously once you're at break-even stage, all of the or majority of all the overhead costs are largely fixed, and then this helps. So this process helps make the case that the investment of their time in the recruitment process is very profitable. So you want to evaluate each surgeon's block time. Some surgeons may be open and be able to be flexible in their scheduling to accommodate the new physicians. You want to also define what kinds of physicians you want and can support, or how you would support physicians that aren't married to another ASC. For example, a natural fit for a spine center is to add pain or other ortho and podiatry. And at one time, we could pick and choose what type of specialty docs we wanted to add. This is not the case in all markets now, as we all know. So what if you had physical space that could handle GI but no GI equipment, and you're not making significant profits to be able to purchase GI equipment? Could you recruit, say, 3 busy GI docs and package them together, have them purchase the equipment, and then lease it back to the center? You can justify that since the center is not highly profitable. In other words, you want to be very creative throughout this process. You want to determine your recruitment process and who will be responsible for driving it. Well, we'll discuss more in depth later as we get through this webinar about the plan to rally the team and whatnot. But you want to discuss this process with the existing partners, physician users, and staff, because everyone needs to be on the same page and understand what we're doing, the importance of the process and the value of the process. In other words, you want to get the buy-in and commitment from as many people that are currently working, staff, whatnot, because you want to essentially put everybody together rowing in the same boat in the same direction. I want to gather current caseload statistics, utilization reports, volume projection, actual cases and current schedules. Get familiar with the other matrix like turnover time that you think makes you stick out compared to the competition, obviously in a positive way. Collect the equipment list, allow you to know what cases you can support. You also want to create physician recruitment material, such as one-page fact sheets, a brochure that has pictures of the center, a map of where the center is compared to the hospital and other landmarks. List all the state-of-the-art equipment, awards that you've won, turnover time, block time, and use it to tell your unique story and enticing message. Are you 100% physician-owned? Do you have physical space that you can expand? What sets you apart from the others around you? One point of caution here, and we'll discuss this more later in the webinar, but I'll advise you to do not put anything in those materials about investing in the surgery center, or that there is a possibility of an opportunity to invest or anything along those lines, because this is covered under securities laws, which prohibits general solicitation. But we'll talk more on that later. Build a target list of physicians in the area that could do procedures. Go broad here. You can compile a list from many different sources, from the national provider database, state provider databases, research who is on staff at the hospitals, etc. On the syndication side, if it's a primary offering, you'll need to get all of the offering documents prepared. A primary offering is when the surgery center sells an equity position and receives the payment for that equity position. If it's a secondary offering is when a current shareholder sells their units and gets the money. You want to collect copies of all the original documents, current financials, any contracts, debt, etc., because we're going to give those copies of all the original documents that the current owners were given with updated financial caseloads, etc., to the new physicians prior to them investing. And we need to make sure that the new guys have all the information disclosed. When in doubt, disclose it in writing. When you sell securities, you need to understand that you must disclose, disclose, disclose. You want to decide how much equity you're going to sell and where it's coming from. You want to review your governing documents. You need to understand those documents because you're going to get a lot of questions around those. I think that covers a lot of it.
Thank you. Curtis, do you have anything to add?
Yeah, I guess from the valuation perspective, just to make sure any of the documents that are put together or any of the arrangements that are made, such as what Blayne mentioned with the GI physicians where they were leasing the equipment, you need to be prepared that all that is consistent with fair market value from the start or from the anti-kickback perspective, just because ultimately those physicians are going to refer their cases to the center, and you got to make sure any of those arrangements, any of the compensation under those arrangements are consistent with fair market value so that they're compliant. And we're going to talk a little bit more about the regulatory issues later and what that means under anti-kickback.
Thank you. Blayne, back to you. You started a discussion on when should an ASC recruit physicians, undergo syndication, or undergo re-syndication.
Ambulatory surgery centers, a lot of them that I see out there, and the physician owners look at the physician recruitment process as a one-time event carried out at some stage in development, which can later be forgotten during the center's day-to-day operation. But what we've seen is the most successful surgery centers, they understand and make recruitment an ongoing process. And for some people, that's going to be a paradigm shift that they'll need to make because the market's changing. There's less people out there to recruit, and those centers that don't adapt to the way the market is now aren't going to survive. If you're not at 100% utilization and your goal is to grow the center, and I say that because some people use it as a tool, and that's not their goal to grow, but say that it is, you should always be recruiting because each dollar of revenue once your break-even point can add up between 65% and 80 cents of profit to the bottom line. The successful recruitment campaigns, in our opinion, are as important to success of your ASC as strong payer contracts and business best practice. And again, the most successful surgery centers have owners that have adopted a physician recruitment mindset. So obviously they take on primarily two forms, de novo, and then selling interest in existing ASC to the physician utilizer, potential physician utilizers. And the sale of ownership interest to physicians who bring cases to the ASC is an important factor in determining the ASC's success. So selling equity interest in the ASC to physicians who regularly use the facility strengthens that relationship, and it's often a prerequisite to the sale of your surgery center. So you also can look at it when you're leading up to a sale of a surgery center, because like Curtis was referring to earlier, adding cases, adding 100 cases a month of paying to your ASC could help you receive, double-digit multiples of trailing EBITDA, as we have discussed in some of the other webinars.
Thank you. Curtis?
Yeah, I think just not much to add there, but I think one of the biggest things that I see is that the center needs to continue to syndicate as practices add new doctors or as practices recruit new doctors to the market. I always kind of see that happen after the fact. You may have a general surgery group or orthopedic surgery group or GI group or whoever that recruits a physician over into their practice, and they have the path of being 3 years out and to be a partner within the practice. And the surgery center doesn't really sell the interest to that physician over time, but that physician starts doing all their cases within the center. And 3 years down the road, they're ready to sell the interest to the center. And as I mentioned before, from the valuation perspective, well, we need to look at the historical volumes within the center. So it makes sense to continue to re-syndicate to those doctors as they enter the market and as they enter the practices that are very involved with that center.
Thank you. Now that we've covered the when, let's discuss the how. Blayne, can you discuss some strategies that you think surgery centers might use to recruit new physician users?
Right. Yeah. As we all know, recruiting new physicians to a surgery center, especially in this mature market, is very stressful, and it needs to be a strategic process. I would recommend that you approach recruitment and retention as one of the same. You need to be recruiting your current docs in order to retain them, because if you're not, someone is. We go out and talk to other docs that are doing procedures at other surgery centers all the time. And additionally, on that same note, when you're recruiting new doctors, you need to approach it with the retention in mind. In other words, you need to make sure that everyone understands that this is a partnership and that you'll hopefully be working together for a long time. Thus work hard to ensure that everyone is treated special throughout this process. But we typically have a two-avenue approach to the process. We work with existing partners, meaning staff and physicians that utilize the center, to develop an ongoing target list. Obviously comes from their knowledge about the physicians that are in the marketplace, new physicians that come in. We also work with anesthesiologists. They're a great resource. And we'll also create a mass list, if you will, of all the potential physicians and surgeons that are seeing patients in the market area of the center. And we'll market to all identified physicians through some avenues we'll talk about in a few seconds. But as everybody knows, one of the greatest assets in recruiting new physicians is the mindset and commitment of the current physician base. I've been in surgery centers that need help, and a lot of that, the reason that they need help is because of the mindset and the commitment from the existing physicians. They don't see it as their job. They see it as the medical director's job or administrator's job. But you need to get the buy-in and commitment, and this support can take the form of a variety of ways, including speaking with new recruits, giving tours, attending new recruit open houses, going on physician visits, going to recruiting dinners, making phone calls, and being part of letter writing campaigns where you guys put together some physician recruitment letters directed to a very specific specialty group, and they turn around and put their name on it, et cetera. They don't necessarily have to write those letters, but they need to be involved. And the role of the current individual owners will depend, obviously, on the personalities and comfort level, but all of them should accept as part of their ownership mindset to be in part of that process. They can, their role can range from sharing names of potential new recruits to all the way being the champion recruiter. We suggest that recruitment of new physicians should be an agenda item on every board meeting, because if they know that they're coming to that meeting and they're going to be asked about, hey, who did you speak with, et cetera, then it's going to be on the top of their mind. And during the discussion on this, they should identify which physicians that we should be reaching out to. So again, they should come prepared to put forth some names. So whoever you've designated as the responsible party can coordinate with that physician the process that you've put together. And all owners and staff need to be a walking billboard for the center. They need to have an elevator speech, and they need to talk about that often, because this is a ongoing process that needs to be at the top of their list. These physicians need to introduce themselves to other physicians that are new to the area on a regular basis. They should be telling these prospective partners about the center, about the opportunity, because some new docs coming out of school, they don't even know about investment opportunities in surgery centers. But again, with that being as an agenda item, it's going to be discussed more and more. And part of the plan, you need to have a updated list, target list, that you guys go over monthly. And then the administrator and the staff should watch newspapers, local magazine ads, all of that for the new physicians that come to the area. Surgery centers can be proactive in their recruitment effort by providing these surgeons with the printed brochures, with the, we also get up like business cards, recruiting cards that has information about the surgery center on the back, real small and easy for those docs to carry around. Also should be using a consistent direct mail campaign to prospective physicians that alternate between letters from partners, brochures, postcards, because the end goal here is to keep the surgery center on the minds of the physicians that are in the marketplace, because you never know when that some new physician is going to come into the marketplace and need somewhere to do their cases, and because someone got your brochure, they're going to have that conversation. I mean, this is what we call the vitamin approach or the drip marketing. The process sometimes has immediate results, but it's really designed to improve the other activities that you're doing over time. So those are some of the things. One of the other things that we've been advocating lately, and we think this is the where we're going, we'll create a direct-to-patient marketing program, because if you have patients that you can refer to the physicians, they'll be obviously more receptive to doing procedures in your center. This is the next wave in our mind with the ambulatory surgery center development. It can involve making regular updates to the website, conducting SEO campaigns, posting ads in the local newspaper, magazines, billboards, speaking with the larger employers, et cetera, to build that patient traffic. You know, and at the end, it's an all hands-on-deck approach, and we see a lot of, you know, hey, let the other guy attitude out there, which is the major contributor for the underperformance of the surgery centers out there.
Excellent, thank you. Curtis, is there anything you'd like to add?
No, not on this one. I think Blayne covered that pretty well.
All right. Well then, Curtis, I'm going to stick with you to start the discussion on the next topic. How does a surgery center value the shares being sold during syndication?
Well, from the valuation perspective, you know, there's three approaches to value: the market approach, the income approach, and the asset approach. And whether you're valuing the controlling interest for sale to a management company or for some other purpose, or you're selling a minority interest to, or a non-controlling interest to a physician or a physician practice, these approaches are all standard from the valuation perspective. The market approach is what most people probably have heard about in the surgery center space, which is a multiple of EBITDA less percent of funded debt. And I put the percent there because obviously you only take the 2% or the 5% or whatever percent you're selling and subtract that from the multiple of EBITDA. And as a lot of people probably hear, you know, minority interest generally trade in the 2 to 3.5 times EBITDA, but probably about 2.5 being the median. And how do we decide where a center falls on that range? That really depends on the different factors within the surgery center, such as, are the physicians locked in with non-competes so that they can't go and have other ownership in other surgery centers? or maybe have some management responsibilities under a co-management agreement with a hospital department, which I know is an issue under some of the older non-competes nowadays. What type of specialties, how many physicians are locked in. It really has to do with the same things that the income approach deals with, and that is, what is the expected future returns on your investment, and what are the risks that you actually achieve those returns, which is generally done through cash flow, which from the ASC perspective is mostly distributions, and maybe some form of capital gains, but mostly distributions. So that's the same as the income approach, and what we'll do under an income approach is we'll look at the projected future cash flows of the business, and we'll present value that based on some risk factor, and that risk factor is actually the inverse of a multiple. So, if we're using a 15% risk factor, that's about a 6.5 multiple, and then to come down to a multiple that's more applicable to a physician interest, which is generally a non-controlling and non-marketable interest, which we'll talk about those factors in just a little bit here. We reduced that amount by a certain percent for those facts that you can't easily market the interest, or the fact that the physicians at a 2% or 5% interest really don't have control in the operations of the center. From the minority interest perspective, the asset approach is generally not applicable because the minority shareholders are unable to liquidate the assets or change the way controlling shareholders utilize those assets. So it pretty much says, hey, I own 2% of a business, and when we would use the asset approach would be when a business is generally losing money or has significant asset holdings, like a real estate holding company. In this case, it would generally be if a business is losing money. But the fact is, just because it's losing money doesn't mean that I can actually go and buy an interest and just all of a sudden turn the center around. If I buy a 2% or 5% interest, if there's a 51% owner, let's say it's a hospital or a management company or just one physician or whoever it is, they can, in essence, continue to manage that business any way they want, and there would be no ability for us to liquidate those assets. So even if your center has, it's in a certificate of need state, at the end of the day, if you don't have the ability to turn that business around, and even if you can use that CON for a surgery center, a profitable surgery center, because it's obviously needed in the market, and for some reason your center is underutilized, or maybe it has too high of an overhead expense or something's causing it to lose money, that CON really doesn't have as much value as it would in controlling interest. So maybe a CON's worth $500,000 or $1 million under controlling interest, even though the business is losing money, because you can take that and turn it around within your market. But from the non-controlling interest, it's really not worth that much, because if I bought 5%, it's really nothing I can do to make the 51% owner or 60% owner or whatever it is change the business. And some of that has to do with your operating agreements, how it's written in your operating agreements. Some of that has to do with state law and what the owner can do from, forcing the controlling shareholder to operate in a different manner under state law. But at the end of the day, we follow these same approaches, and we come up with the value based on the same facts.
Thank you. Blayne?
What we see a lot of times is the operating agreements state that the valuation for physician buy-in or for syndication are done by this method or by that method. Some would say, hey, it'll be done by 2.5 times trailing EBITDA, or some would say at fair market value. So I would tell you, hey, go look at your operating agreement, and that's how you're going to figure out how you're going to value it. And then if it says, hey, we're going to do it by fair market valuation by third party, then obviously what Curtis was saying is how they're going to go about doing it.
Yeah, and I think that's right. I mean, a lot of operating agreements do have that fixed amount, whether it's generally like 2.5 times EBITDA less the percent of funded debt, and that's fine. I mean, so long as there's no major changes expected within the operations. It might go down if you have potentially a significant loss of orthopedic surgeons. From your volume, they're leaving for one reason or another. They're being practice being bought by a hospital, and you're not expecting those cases going forward. Major capital expenditures, anything that might cause a significant change in operations may affect that multiple to move. But in general, that's probably within a reasonable range from a fair market value perspective. But before you just blindly apply it, even if the operating agreement requires it, you need to know, one is, are there any major changes that might affect that? And then two, what are my regulatory risks associated with that? Because at the end of the day, if you're paying less than that to buy out a physician, you might be okay from a regulatory perspective, because you're not going to pay them less and expect them to refer. Obviously, you're going to pay them more. So you do need to consider those two factors.
Excellent. Thank you, Kurtz. Going to stick with you to start our discussion. Next topic, what can an ASC do to lower the cost of the shares or units being sold, and why would a center want to devalue its shares?
Mm-hmm. Yeah, so I think from that last slide, the main point to take away is valuation primarily has to do with a few things here, right? One is projected cash flow. Two is the risk associated with achieving those cash flows. And then three is the debt. So what we see is, when we're looking at the projected cash flow and the expected rate of return on that cash flow, you may have the value of an interest for a physician that gets to be pretty high. It might be $50,000, or it might be $100,000, or even higher for a minority interest. And I think Blayne told me that he's seen even higher than that. And the idea with that is that I'm going to put in money today, and I'm going to get a significant amount of money out, and I'm going to get a decent return on my investment. And that's how things need to be looked at from the fair market value standard. Well, the issue you get into is, a new physician's recruited to the market, and they have the choice of going down the street and investing $15,000 into a new surgery center, or it may cost $100,000, which they may not be able to afford to buy into your center. And that's always a challenge, from the valuation perspective. So the question is, how do you lower that $100,000? And I think Blayne touched on before, doing certain types of leases, like with the GI. Obviously you're getting cash out of the business by entering into leases, whether it's with a third party or if you just create a separate company, to own the real estate and lease it back, or to own the equipment, or to employ the staff, lease the staff to the surgery center. You can take on more debt. I think Blayne talked about this in the last webinar, and you might want to talk more about it in this webinar, about taking on more debt and making distributions to the current owners before the investment. So really anything you can do to decrease the cash flow and increase the debt before the investment. Obviously, we're going to talk a little bit more about regulatory in a little bit here, but from the regulatory perspective, and I'm not an attorney, I just know what I've read from the Office of the Inspector General in the past, and one of their main concerns is a physician earning too high of a return on investment. They don't want to see someone put in very little money and then all of a sudden make a windfall off their investment and do it just because they're referring to an entity. So that is a concern of theirs, so you need to make sure that it's all above board and that the valuation is correct, even taking into account any different strategies to help lower the value of a unit.
Thank you, Blayne.
Yeah. Let me hit on the why question first, and it's probably obvious to most people, but some other people not, because I have this question quite often. But ambulatory surgery centers are highly dependent, obviously, upon the cases that the physicians choose to bring to the center. And one of the most impactful reasons surgeons choose to bring cases is their ownership position, right? And so the reason that you'd want to devalue the shares is so that that surgeon or more surgeons have the ability to buy equity in the center, because like Curtis was referring to, some centers have significant buy-in prices. I've seen them $300,000, So I always say that you not want to make money on your syndication, you want to make money from your syndication. And with historical interest rates low, you could consider adding the debt to the center. It's referred to as a dividend recap in the investment banking world. And so what you can do, you can go out and get the debt, borrow the money, and you can distribute that money to the existing owners, and that allows them to realize essentially the same money in their pocket and allow the new surgeons in at a lower buy-in price. You still have debt service, which means that you still have to pay that debt off, but so the return on investment's lower for those new surgeons, but their investment was significantly lower as well. And I know this is not what the question was, but there's some alternative methods along the same line, some things that you could also do to help make it easier for surgeons to get in. Some of these strategies include selling a fractional interest. So instead of selling them one share, you can sell them a half a share. You can dilute the shares by doing a stock split. You could locate a list of third parties that are in the business of lending money, and that's all very specific. They need to be in the business of lending money that is not associated with the surgery center that will finance the investment. So those are some other things that will help you achieve the same goal of getting these surgeons in, but I get that it wasn't part of the question.
Thank you. Well, we'll move on to the next question, Curtis, and return the floor back over to you to lead the discussion, start the discussion on this one. Why are the multiples less of minority interest purchase compared to control interest purchase?
Yeah, so as I kind of briefly touched on before, I mean, the big difference is that lack of control and the lack of marketability. So, you know, one thing you can do, going back to the last question on reducing the value, is prove to the evaluator that you're really unable to market the shares for one reason or another. Maybe all the other physicians within the market have an ownership interest in ASCs and are locked in with non-competes or co-management agreements or some sort of other type of agreement which would prevent them from having ownership, which really limits the ability. Because when you look at the operating agreements, you may see within the operating agreement that you have Class A shares, which is, you know, the management company or some other entity, and Class B shares, which are the physicians, and they may specify that, you know, Class B are ophthalmologists, and Class C are, you know, orthopedic surgeons. And you know, if you're looking to sell your certain Class B shares, you can only sell those to ophthalmologists. But yet all the ophthalmologists in the market are pretty much tied down, except for maybe the one or two you're looking to sell to. So it makes it a lot more difficult to sell within the market, and that, you know, that makes the argument obviously for a higher lack of marketability discount. And same with lack of control. You know, we look to the operating agreement for the provisions for the lack of control discount, and we say, you know, what can this controlling shareholder really achieve, or what can they do? A lot of times the minority interest holder is not able to make any changes to the business. So, I mean, here are some of the just quick definitions of these discounts. You know, the discount for lack of control is taken because the interest holder has no ability to change what a controlling interest holder does with the business. The value is lower with the less control that the minority shareholder has, but the discount for lack of control is actually lower. For example, if there really is no true controlling shareholder, you know, a 5% interest holder is able to have a little bit more authority when you have 25% interest holders versus when you have one 60% interest holder and 8 5% interest holders, both equaling 100. The discount for lack of control is going to be lower if the business is historically run in a manner in which the minority interest holder would operate it. So if it's running smoothly, it's an ASC, obviously it's doing surgeries, you know, that might argue for a little bit lower of a discount for lack of control, just because the minority interest holder would have no desire to change it from the way the controlling shareholder operates it. Obviously, you still have the issue that the controlling shareholder at the end of the day can pretty much do what they want. If they decide tomorrow they want to take on some GI, the 3 GI physicians that Blayne was talking about, but those GI physicians only do, you know, 5 cases each, and you spend all the money on the scopes and the build out of a new OR or specialized GI suites, whatever. You know, at the end of the day, there's nothing the 2% or 5% interest holder can do. Discount lock-in marketability is the discount taken because the investment is privately held and the interest holder may incur significant selling costs and have a lengthy holding period before the interest can be sold. So what it says is, you know, if I'm a physician and I buy my 5%, let's say I'm, you know, 65, I'm ready to retire and I have this 5% interest and I want to get out of the surgery center, but yet I can't find any physicians that want to buy in, you know, unless the surgery center is willing to buy it back from me, or another doctor that, you know, is in the center wants to increase their interest, I really am unable to sell that 5%. And even to sell it, you know, I'll probably have to get some lawyers involved and pay a certain amount. It's not the usual $10 E-Trade or TD Ameritrade, whatever fee to sell my interest. It's going to be a little more. There's going to be some paperwork. I'm going to incur some costs. I'm going to have to hold on to it until it's done. Well, the discount for lack of marketability also could be lower because of the fact that, yeah, I have to hold it on for 6 months per year, but during that time I continue to get distributions from the center. So I'm still earning money off that interest. Also, you know, it may be higher, as I talked about before, when the number of potential buyers is low. So that increases the time that I have to spend holding it. It increases the amount of money I have to spend and time I have to spend marketing to find a potential owner of the interest or someone who's interested in purchasing that interest from me. So those are really the two main valuation issues that you deal with that can create that difference between a controlling interest, which you'll hear some range of like 5 to 7 or 5 to 8 in there, and then a minority you'll hear 2 to 3.5, let's say, maybe even 4. And the difference there is really this lack of control and lack of marketability.
Thank you, Curtis. Blayne?
I think you covered everything.
Excellent. Well, final question, Curtis. I'm going to go back to you to start a discussion before we begin the Q&A portion. Can you start us off discussing what are some of the regulatory risks associated with physician recruitment and syndications?
Yeah, I mean, as I briefly touched on before, you obviously have the anti-kickback law or statute, and like I said, I'm not an attorney, but it does require that the transaction be enacted at fair market value. Certainly some transactions can be below fair market value and some could be above fair market value depending on whether you're buying or selling, and it's really a question more for your attorney on you know, whether you're okay not being actually at fair market value. But most of the time things are transacted at fair market value, and fair market value generally means willing buyer, willing seller with knowledge of a transaction, which means you can't just, you know, start ignoring certain facts such as okay, this physician does 200 cases in the center and he's looking to buy the interest, therefore I'm going to ignore his 200 cases. Well, that would be specific to that buyer, whereas from the fair market value perspective, you have to look at, well, what if any, you know, ophthalmologist is buying that Class B membership, not just a specific ophthalmologist who already is in the center. And I think from the syndication perspective, another very interesting thing to point out and emphasize is that you can't just go and sell your interest based on the level of referrals. Dr. A does 500 cases, Dr. B does 250 cases. Therefore, Dr. A gets 5%, Dr. B gets 2.5%. You know, from the legal perspective, you have to offer the 5% to both doctors, and if Dr. A ends up buying 5 and Dr. B ends up buying 2.5, that's fine. But you can't just offer, you know, 5 to one, 2.5 to the other. It needs to be on the same level, and I'm sure Blayne can probably get more into that.
Blayne?
Yeah, from the investment banking standpoint, I'd say that syndications involves the sale of securities, whether you're selling shares, LLC units, limited partnership units. In federal and state securities laws determine the manner in which the offering and the sale of the ownership interests must be conducted. They also control who can affect the sale and how they affect the sale of those securities. And regardless if it's a primary offering, which again is when the ASC company sells their interest and gets the money, or a secondary offering where the physician sells their interest and gets the money. you have to have this thing documented. You have to have the disclosure documents, the offer memorandum, purchase agreements, or some similar instrument. And the primary purpose of these documents is to fulfill the disclosure requirements of the Security Act and to shield against any future charges of against the anti-fraud provisions of the security laws, etc. And the gist of this is the documents is to assure you have an educated buyer, educated in the sense that they know what they're getting into. I've also seen some doctors trade these securities often. And, well, the securities laws, as well as most of the transaction documents that I've read, mimic the law and state something along the lines of you acknowledge that the purchase of these securities is for the investment intent, not for the resale, and that the security must come to rest in the hand of the investor. Different states have different interpretations, but you just need to be aware of that and pay attention. And one of the most common questions that I get, and we've touched on this a little bit earlier, and it's very interesting and very important, but it talks about the pre-offering communication that can be had with the physicians. The Security Act most of the time prohibits the issuer, which is the person, the ASC company, from engaging in any form of general advertising or general solicitation in connection with the offer or sale of securities in exempt private offering. Most states mimic this as well. It's not real clear what the definition of that is, but kind of the threshold is that you have to have some pre-existing relationship with the person that buys those shares. So you can't go out there and take a letter that says, hey, we want to sell XYZ amount of shares. We want to, we have them priced at this amount. Hey, are you interested? We recommend sending out the physician recruitment letters and brochures, etc., before you ever get to, and you establish a relationship with those physicians, before you ever get to offering them an investment in your surgery center. Obviously, like Curtis said, you want to offer the shares, equal shares to all the physicians. We have a situation now where one physician wants a significant bigger portion, and we won't allow it because we haven't offered that to the rest of the physicians. And you can use the laws to support you in that, and obviously the physicians get that once you explain it to them. Investors must fully disclose that he or she is invested in the surgery center to the patients. So we have it, it's out there in the lobby, the list of the physicians. Also, here's kind of an interesting one that neither the ASC nor its owner nor any affiliate of those guys can loan monies to a physician for the purpose of acquiring an equity interest in an ASC. So I couldn't be working for a surgery center, and that surgery center asked me, hey, can you loan money to Dr. X to buy those shares? It can't happen. Another interesting one with some interesting twist is that all of the transactions that I've dealt with have required that the investor be an accredited investor. And for this situation, investing in surgery center, it's defined as a director, executive officer, or general partner of the company selling the securities, a business in which all the equity owners are accredited investors. So think as if the physician sets up an LLC to invest in the ASC, the physician that owns that LLC must be an accredited investor. A natural person who has individual net worth or joint net worth with the person's spouse that exceeds $1 million at the time of the purchase, and the new twist that's come out recently excluding the value of the primary residence of that person, or making $200,000 per year in the 2 most recent years with the expectation that they'll make $200,000 the current year, or $300,000 for a married group. And there's some options here. So if you have a physician where their income or net worth does not qualify them as an accredited investor, you can make them a director or executive of the surgery center so they qualify. So director and as in the board of directors or an executive as the medical director. You can also request a no action letter from the state if it's only controlled by the state, or by the SEC if it goes across state lines, to ask, hey, can we get around this rule?
Excellent. Well, that concludes the roundtable portion. We do have time to take a number of questions. As a reminder to our participants, you can submit your questions by typing them into your control panel in the space labeled Enter a Question for Staff and clicking Send. Before we get into the first question, I just wanted to let those folks know if you submit a question and we don't get to it, don't worry, your questions will be passed along to today's panelists. But you can also follow up with Blayne, Curtis. Their contact information is on this slide here. Mine is as well. If you have any feedback or follow-up questions, Ambulatory Alliances will be hosting webinars throughout the rest of the year. So if you have any requests or suggestions for topics for those programs, again, feel free to contact Blayne, Curtis, myself with any suggestions or thoughts you have. Let's get into the Q&A. First question. What is the best way for a group of physicians in an existing ASC to protect themselves and their hard work in getting the business established when expanding business to add a new group of physicians? Blayne, can I have you start us off with that discussion?
I don't know if I fully understand the question, but let me repeat it and see if I understand it. So you have an existing surgery center with existing physicians that are looking to expand with another group or another some other physicians, and how do they protect themselves? Again, I'm not a lawyer, but I've been through and read these documents till I'm blue in the face. And one thing is you can carve out and make, and Curtis mentioned this, you can make different classes of shareholders. So you can create a founders shareholder class, if you will, and you can justify that. I've seen it justified because you started it, and you put in the risk and the sweat equity and maybe financial equity, et cetera, to start that up. So you can create different rules for you guys at different levels of our classes, if you will, of shareholders, and have a group of rules here for you and a group of rules for the new guys that come in. That's what comes to mind.
I believe you interpreted that question correctly. Curtis, do you have any follow-up and any follow-up thoughts?
No, I mean, those were generally my thoughts. You know, obviously putting different ability to control within the operating agreement and other, obviously within legal bounds and regulatory, SEC, whatever bounds, as Blayne can help with.
Excellent. Thank you. Blayne, next question. I'm going to direct it to you. This participant praises you for some of the good advice that you gave around techniques to use in recruiting physicians, but notes that they've tried many of them that you mentioned. What do you suggest if those suggestions that you already gave didn't work?
Yeah, good question. So I'll make a couple of assumptions here. I'm going to assume that the market has recruitable doctors, because you could be in a market that has no recruitable doctors. So therefore, it doesn't matter what you do, you're not going to recruit one. I guess another assumption is that your surgery center is attractive, meaning that people would want to work there. You know, so you can, and then go to the techniques. Obviously, you say that you tried most or all these techniques. It comes down to the person that is doing the actual recruitment, in my mind. You have to find a champion physician that has the ability to go out and move people with their mouth and their presence, and that people instantly respect. I've been in situations where you look at a surgery center and you say, man, there is no reason that that surgery center shouldn't be highly profitable and very successful. It comes down to the person that was actually doing the recruiting. So one person can be using all those same techniques, and another person that has a different use of words, a different dominance, whatever, a different style, and they're able to accomplish a lot more. That would be my suggestion. Look at who's doing the recruiting.
Curtis, do you have any additional thoughts?
No, I mean, the only thing I could probably add to that is just that, you know, all the other physicians that are involved with the ASC have to allow that chief recruiter to do their job. Obviously, there's a lot of egos within surgery centers, a lot of different physicians, different specialties, whatnot, and we see that in every business, whether it's my business or surgery center or whatever it is. There's certain people that can do recruiting. There's certain people that can do perform procedures and whatnot, and everyone has to know their strengths and be willing to allow their teammates to use their strengths to help benefit everybody.
Excellent, thank you. Let's see if we can get through a few more questions before we wrap up. Curtis, I'll see if I can start with you on this next question. What is the best way to credit in quotes, a current investor who is doing a considerably higher volume of cases than other physician investors, but not having him purchase more shares?
Always a difficult question because you're restricted from the regulatory perspective on on certain things, but have them more involved in the leadership of the ASC. You generally have a board of directors. You might have medical directorships that involves leadership. So I think that gives that person obviously a feeling that they're actively involved. It's probably a little bit of a question for an attorney on what else you might be able to do within a legal bounds, because you can't just obviously pay money for no services. You can't just distribute money for no reason. It obviously has to be distributed based on your ownership percent. So there's obviously certain limitations on what you can do as far as rewarding them monetarily without having them actually provide some level of personally performed services.
Mm-hmm. Blayne, any thoughts to add?
Yeah, let me make sure that I'm answering a different question just for the obvious reasons. I would say ask your attorney, but some of the things that I've seen that have gotten physicians more involved in the surgery center and that I've seen done before that you could at least ask the attorneys if you're able to do that is I've seen co-marketing agreements, I've seen medical directorship agreements, co-management agreements. Those types of things are where you could at least explore options, if you will, and find out from your lawyer if those things are that you can partake in, but those are things that I've seen before.
Terrific, thank you. Blayne, I'm going to stick with you for this next question. It's a two-parter. How strong are partnership non-competes, and have you seen non-competes overturned, especially restrictions over several years, as well as a unit price penalty?
Yeah, we write in, some surgery centers have non-compete, some don't. I'm working one in particular that the market is tough to recruit in. There's a lot of doctors married to other centers, and they want to keep some independence, et cetera. So we don't have a non-compete in this particular one. What we did was strengthen the 1/3 rule with a clawback, and essentially as they have to do 1/3 of their cases, and I mean there's a whole list of definition on that, but just to summarize it, and if they don't, we also have audits, so that everybody agrees in writing that we'll have quarterly audits, and then clawbacks. So if they're not meeting that after the second time, after they've been told, hey, you're not meeting it, then we claw back. So there's some surgery centers have non-competes, this one doesn't, and that's what we did to help do some protection, but get into the non-compete. A lot of them do. Some places do not enforce it, they act like it doesn't even exist to some physicians. I don't know why. It's not, I'm not involved in some of those surgery centers. I have seen clawbacks. I have seen lawsuits, but most of those get settled. Most lawsuits get settled, obviously, before they go to court. So I think it's yes, yes, and yes to the answer.
Curtis?
I think Blayne covered that pretty well.
Okay, perfect. Well then, Curtis, I'll stick with you to start discussion on. We'll take a couple more questions, a little bit over the planned end times. We got a lot of questions here, so a couple more. Curtis, it's another two-part question. Have you started discussion? Do you need a valuation when first developing an ASC, and how are initial shares valued?
Okay. You really don't need a valuation when you first set up the ASC. Usually shares are valued based on the expected cost to set up the ASC. You've got your legal costs, you've got your capital expenditures, your build out, your equipment, and all your other costs. So you can usually just set up, based on how many shares. Let's say you want to have 100 shares, and if your overall cost to set up the ASC were, $150,000, you might want some initial working capital in there to pay your rent, to pay for your staff, whatever it is. And each position would buy in for $15,000, and then as other expenses are incurred, you probably just do a cash call, a capital call, as you're building out the ASC and getting it up and running. So really no need to value the shares at the front. I mean, some centers do. We valued them if you got a number of doctors who have started the surgery center and they've got it kind of close to up and running. They've got a space, they've got the build out has started, Medicare credentialing has started, whatever it is, and now you have new doctors who they tried to recruit at the very beginning and syndicate shares to at the very beginning, did not purchase, but then now want to purchase before the center's actually up and running. We have done valuations on those types of entities as well, and it's a little complicated because usually what you're going to see is a little bit of a dip in the value of the interest before it starts running, depending on where it is and the expected projections and stuff like that. So it becomes a little bit of a complication because doctors may have put in 15, 20,000, all of a sudden the shares are worth 10. So it's really good to get those doctors involved in the very beginning, because you may have some complications and issues if you get a valuation done and shares have gone down before it opens. There's usually a trend of I'd show you on a chart if I could, but it's where the value of the shares kind of do a little dip at the very beginning and then start heading back up as more doctors are using it and as cases ramp up and it gets fully credentialed with all the payers and everything and gets moving.
Thank you, Blayne. Anything to add?
No, I don't.
Okay. Then we'll do our final question here. Actually, let's do two more, and then we'll wrap up shortly after. Blayne, I'm going to direct this question to you. Busy out-of-network center. Operating agreement states that the center value the shares for physician buy-in at 3 times trailing EBITDA, which they say is a high buy-in price for some physicians. What can the ASC do to justify a lower share price?
So assuming that they're basing the value on the out-of-network revenue, well, obviously the valuation guys are going to adjust that and normalize it, if you will, in some form or fashion. So some of them will take and say normalize it to what would be expected in that market for in-network centers, and therefore that's going to drive down the cost. So I would say, hey, if your operating agreement allows for it, then go hire a third-party evaluation company that's going to turn around and discount that, and if it doesn't allow for it, then change your operating agreement and go hire a third-party evaluation guy.
All right. Curtis, do you have anything to add?
No, that's
okay.
all covered.
Well, before we get to the last question, then I'm going to ask Curtis and Blayne to provide some brief final thoughts. Again, just as a reminder, if we didn't get to your question, don't worry. The questions will be passed along to today's panelists. And again, I want to direct your attention to the contact information on the final slide. If you have any additional questions, feedback, or suggestions for programs, get in contact any of us, or feel free to respond to any of the emails you received concerning the program. Just hit reply, send your thoughts and feedback, and we'll make sure to get them. So final question, I'm going to have Curtis, you start a discussion on this, and then we'll do some final thoughts. This participant is in an ASC with a CON, and they hear that certificate of needs can be valuable. How is the CON considered when valuing a physician's interest?
Yeah, I kind of briefly touched on this before. I mean, CONs generally are valuable, but at the end of the day, if the center is not operating efficiently and using that CON to its highest potential, there's really nothing a minority interest shareholder can do. I mean, barring any state law, and obviously depending on the operating agreement, I should say. If the minority interest is unable to change what a controlling shareholder does with that CON and is unable to recruit new physicians, and there's need within the market to operate at a higher level with that certificate of need, there's really not much they can do, and they don't have the ability to liquidate the certificate of need in any sense. So it while CONs may be, like I said, worth $500,000, million, whatever it's worth, depending on the market. From the minority interest perspective, it doesn't increase the value of the center as much. Obviously, if a center has a CON and it's operating at its highest function and it's operating, then within that 2.5 times EBITDA less debt, that CON value is included already. So that that should include all the assets necessary to operate the business, which the certificate of need is one of.
Thank you. Blayne, do you have anything to add?
No, I don't. I think you covered that pretty well.
Well, excellent. Well, that concludes the Q&A portion. I'm going to ask Curtis to share some final thoughts, and then Blayne as well, and then we will wrap up. Curtis?
Yeah, I mean, from my perspective, I think syndications could be tricky at times. Obviously, there's multiple of earnings that can be used within operating agreements to help with the sale and the dollars, and obviously you have to deal with the regulatory issues and SEC issues and everything else, and just make sure that all that's being dealt with appropriately.
Thank you, Curtis. Blayne?
Yeah, I just appreciate everybody spending time with us today, and I'd encourage you to reach out and connect with Curtis and I on LinkedIn or Facebook, or follow us on Twitter so you can get more information about articles that we write, about these sessions that are coming up, etc. And also encourage you to think about other topics that might be beneficial to you, because if they're beneficial to you, they're going to be beneficial to other people, and reach out to us and make those suggestions.
Thank you, Blayne. I also want to certainly thank Curtis. Both of you delivered a terrific information during the roundtable. I appreciate your taking as much time as you did to tackle as many of the questions as we could get to, and I certainly want to thank all of the participants for joining us for today's program. And this now concludes today's webinar. I wish everyone a wonderful afternoon and a great weekend. Thank you.